Now let's turn to the annuities. This is the participating annuity, and these charts are actually done on a cash flow basis. So we have assumed an initial benefit payment of $10,000 in each case. So if you started with an initial benefit payment of $10,000 in 2006 when we started these, in 2007 you would have received $10,350 and $10,971. In 2009 we did not adjust the payments, and they will not be adjusted for 2010. Basic annuity, once again, tied to fixed income. It's totally supported 100% by fixed income investments, so it's going to mirror interest rates, and given where interest rates are, the 4% earnings assumption is about where we are in interest rates. So we don't really expect a change in the basic annuity over the near term. If interest rates should rise significantly or fall below that 4% significantly, then we would expect a change. But for now, the basic looks stable. This is the equity benefit annuity. Increases came, but there's a lag in making these. So these are the actual cash flows. And in 2009, actually, the cash payments from this dropped about 35% because of the lag. I'm happy to say that on April 1, interest rate, the benefit payment went up 18.8%, and that reflects the lag from 2009. And the balance benefit in 2009, that benefit payment actually dropped 22% on a cash flow basis, but on April 1, that increased 13.6%. So where do we go from here? This chart shows bear markets and recoveries. And you can see that the bear market that began in October of 2007 was one of the most severe bear markets we've had. The S&P declined 56.8% from the peak in October until it started turning around in March of 2009. Now, when this chart was done, we were up a little over 75% through April 30th. Now, May was a tough month in the market, the fear of decelerating growth, so we've given up about 12% of that. It was the first correction we've had since the market turned around in 2009. So it's not unusual to have a correction. The question is, does it mark the beginning of another bear market, or is it a correction only, and we'll resume upward? My personal feeling is that it is just a correction, and we'll resume, and I'll get more to that. This is a chart of interest rates going back to 1798. You can see the red line is short-term interest rates as represented by commercial paper. The blue line is long-term rates for some corporates. That red line can't go any lower. The Fed has had a 0 to 25% interest rate policy since the beginning of the financial crisis, so there's only one way for that to go, and that is up. Long bond yields, actually, if you look at that decline, this is like one of the biggest bull markets in bonds we've ever had. And when we had the inflation of the 70s, when interest rates went up to 19%, we've had a terrific recovery, and so bond returns have been great. Going forward, something's got to give here. As short rates go up, we think long rates will go up, and even though inflation right now isn't an immediate threat, in the long run there's been a lot of stimulus in the economy, and the danger is that inflation will take hold again. So we believe that bond yields will rise over time. The question is when. It's coming. Within the next couple of years we'll see bond yields higher. So we think that long-term bond returns are going to fall in a range over the next 10 years of about 2 to 5%. This is a chart of stock prices going back to 1871, and the blue line represents stock prices, which is on the left margin, and then the red line is earnings. Now, stock prices follow earnings, and you can see that based on this, I mean, what analysts look at when they're looking at values in the stock market, they look at price-earnings ratios. So if you take the price of the S&P, which on April 30th was around $11.97, take those earnings through the first quarter, which were at the time $60.83, that comes out to about a PE ratio of 16, 17 times. That's like fair value. Now the good news is, and well, it could be good news, let me put it that way. Analysts are expecting interest rates or earnings this year in 2010 to go up to $85. If that comes true, then stock prices at these levels are very inexpensive. The PE drops to about 13 times earnings. So if those earnings are realized, stocks could do very well this year. It just is a matter of whether those expectations are met. There are bumps along the way. The sovereign debt is a real problem. The deficits have to be reduced, and there are only 3 ways to reduce the deficit. You can grow your way out of it, you can cut spending, or you can raise taxes. And so there's going to be a little bit of all of that, I think, in how we do this. But we've seen what happened to Europe with the problems in Greece. Now, Greece is not a large economy, and you think, oh, geez, you know, why is this having such repercussions in the market? Well, the problem is that banks are the big holders of Greek debt. And so the fear is that the banks in Europe are going to have a liquidity crisis again because they have a lot of bad debt, and if Greece restructures their debt, they're going to have to write down those loans. So that's what the market is focusing on. We think, you know, they're talking about, well, we have emerging markets, China, India, they're growing, but China exports about 30% of its product to Europe. And so if Europe slows down, they think the global economy will slow down. So given that we've been on a debt binge, we think growth is going to be, you know, somewhat below trend. And because earnings follow growth, we actually think that stock returns are going to be below what we've experienced in that period from 1926, you know, through 2009. It was average 9.8. We think going forward over the next 10 years that stock returns will fall somewhere on average, you know, 6 to 8%. Now this is just the average return. You know, taking a look, as you saw in that first chart, stock prices can be very, very volatile. So they can be down, you know, 40%, they can be up 50%. So within that range, but over the long term, we think that stock returns will fall in the 6 to 8% range. And because of the volatility, the pension boards, this is a schematic of where our investment options fall on the risk-return spectrum. And risk is on that bottom tangent, and return is on the left side. So the idea is the further out on the risk spectrum, as you move out to the right of that chart, you should get a higher return because it says that higher risk should earn a higher return. So we've put our investment options on this to show what is the least risky, the stable value fund, and the most risky is the equity fund. But you get the higher return in the equity fund than the stable value fund. We've put the TAD funds along this line, and right now the TAD 2015 fund falls between the bond fund and the balanced fund. But as we approach that year 2015, that will become less risky than the bond fund because the asset mix by the time you approach retirement will be 60% stable value, 40% bonds. So we offer a lot of different options so people can adjust their asset allocation to suit their risk tolerance and their investment time horizon. And what we really want people to know is that for a large allocation to equities, you do need a long time horizon, as this last decade has shown, that equities can be in a funk for a long period of time.